and you can just hit record. That would be nice as well. Anybody from CBS, by the way, can start recording. We're not, I hope this is okay with you guys. So we would like to make it available to people afterwards who can't be at the session. So keep that in mind in our discussions here. So yes, Florence, thank you very much. It's wonderful working with you. We have two excellent speakers in this session, Laura Kemp-Pedersen, who is a impact investing practitioner, who will talk about her experiences with gender lens investing, and Karthik Varada, who, as I said before, was already a speaker at the Beijing Impact Investing Days and is a kind of like ideal representation of this kind of like joining of practitioner and academic world. You are a practitioner, you have worked with gender lens investing, but you're also an academic. You actually defended your PhD thesis a few weeks ago. Huge congratulations, Karthik. And with that, I'll hand over to Florence for the facilitation of the session. And here we go.
Hello, everybody. So nice to see you. I was about to say good morning, but we're probably in different time zones. So wherever you are, whatever time it is wonderful to see you this morning. I'm Florence Villeseche, Associate Professor and Academic Director of the Diversity and Difference platform here at CBS. And I'm thrilled to moderate this talk this morning with Karthik, who's going to speak first, and then Laura. Kai has introduced him briefly, and I'm half Swiss, and my half Swiss part tells me we're already back on the schedule, so I won't talk too long. Yes, so how it's going to be structured is that Karthik is going to make a short presentation, and then I'll have a couple of questions for him. Then it will be Laura's turn, and then we will open questions for the floor, and I have a few more questions in stock, and maybe they even have questions in stock for each other before we move to the small groups. So it will be fast and dynamic, and I'm sure it will be very insightful. Thank you so much. Karthik, I give the word over to you. So Karthik will share his screen, and then he will also unmute so you can hear him and no longer me.
Hi, can you hear me? I'm sorry. Okay, thanks. Looks like my computer suddenly decided to give up on me, and it is overloaded in the RAM, and I'm not able to really share my screen, but please bear with me for 1 second.
Yeah, I know team can be
possible for you to share my presentation that I have just sent over the email, if that's okay.
Perhaps if I
sorry, my
all of us who are not speakers, if we just switch off our cameras, this might help. Sorry for that. It's not as nice, but if we just keep the cameras off, and then later in the breakout rooms we can switch them on again. I see that we're at 63 participants, and I just don't know where the limit of the program is. So just please switch off your cameras unless you're.
Thank you so much. Are you able to see my screen now? Please let me know if my screen is sharing. Great, thank you so much. So, well, thank you, Florence and Kai, for the great introduction. And I will try to keep my comments brief and provide with you a brief overview of this activity, the so-called activity of gender lens investing, and talk about why gender lens investing, or this whole approach of a mindset of adapting a gender lens to any sort of decision-making activity we take. Why is that mindset of adapting a gender lens very important in these times of COVID-19? So firstly, I think it's very clear to most of us in the room, if not all, that the impacts of COVID-19 are not gender neutral. In fact, men and women in different countries across the world are subject to different risks in different spheres of life because of COVID-19. An important notion, for example, is that while more men are at risk of being appointed into intensive care facilities because of COVID-19 related infections. When it comes to the social and economic spheres of life, it is women across the world that are bearing the significant burden of COVID-19 and related disruptions that it has caused. For example, one study says that 20% women are 20% more likely than men to sort of like get into unemployment because of the economic disruptions due to COVID-19. Some other study said it is 1.8x, but I could not really find a rigorous reference to that, so I wouldn't use that number. But in general, I think there is a broad consensus that women are subject to greater risks of unemployment during COVID-19. At the same time, especially in developing countries, where significant majority of women operate in informal economy, any amount of aid or stimulus packages that governments announce generally tend to not reach these women in time. And even if there is a couple of months delay before which women-led micro-entrepreneurs receive any sort of aid, those couple of months is enough to cause sufficient amount of a great deal of economic devastation to their own business and to their families. And in fact, it's the effects are not limited to economic sphere. When we look at school education in India, in the last 10 years or so, there has been significant improvement in the enrollment of girls into school education. But because of COVID-induced school lockdowns, majority of girls and boys, of course, have not been going back to school in the past couple of years. But some early ethnographic surveys indicate that girls are more likely to be held back at home than boys, even after the country recovers from COVID crisis. So there is indeed a great deal of reversal in the gains that that the society has made towards gender equality in the last couple of years because of COVID. And in fact, when we can, and I think something that many in this call would empathize with is about the unpaid work that women engage in at home. And even before COVID, majority of the unpaid childcare, elderly care, and other household affairs related work is generally conducted by women in the family. And the amount of expectations pertaining to unpaid work has only increased because of lockdowns, because of school closures, etc. And it is women that are generally subject to greater pressures and stress because of extra amount of unpaid work that is expected of them, while also balancing remote work by working at home. And this has indeed resulted into greater mental health related effects for women than men in the world. So the effects of COVID-19 in more broadly are not gender neutral. They have different effects for men and women, and any investment activity or any decision-making activity at a policy level even requires that we understand the effects for men and women separately and try to really build solutions that are more nuanced and that address the different needs of different groups. Now, this whole idea of adapting understanding how a certain issue would influence men and women separately. It is a short form for that could be to say that let's apply a gender lens. Let's apply a gender lens to our thinking. Let's apply a gender lens to our decision making and analysis processes, etc. And that helps in gaining a deeper understanding of the issues at hand. And in the last decade, since 2010, this phrase of applying a gender lens has also gained popularity among investors. And now we have a thriving practice of gender lens investing, which is to essentially deliberately try and understand how gender-based norms and gender dynamics within a society will influence the financial outcomes of a certain investment, with an expectation that the investor would generate better outcomes, both financially and also from a social impact point of view. There are a wide variety of gender lens investment strategies by which one can incorporate this so-called gender analysis into decision-making process. And here are a few examples of what that strategies could be. For example, a typical gender lens investment strategy would be to invest in women-led businesses. Across the world, the amount of funding that female entrepreneurs receive is only a tiny fraction of the overall venture capital funding that is available in the world. Depending on the survey, the amount of funding that women receive is often less than 5%. So this points to a big bias in the society of venture capital investing, and investors who take that extra step of learning about being open to uncovering these biases and trying to increase their deal flow by identifying more female entrepreneurs are likely to benefit from this activity. Similarly, there are many other areas in which we can really adapt a gender lens to our decision-making process and thereby gain a deeper understanding of what we are doing. And eventually hope that this deeper understanding will help in improving the financial outcomes and also the social outcomes. So that's the theory, but I thought it would also be interesting to share a couple of examples on how this materializes in reality. So there is a agricultural company based in Peru called Danper, and I learned that it's indeed a joint venture between a Peruvian company and a Danish company. So they've recently been, they're one of the prominent portfolio companies among gender lens investors in Latin America. And gender lens investors like Danper because Danper really takes a deep, a very serious approach towards, building its employment practices to be more gender inclusive. They offer the women in their, about half of their workforce comprises women, and they take serious steps towards trying to understand the needs of both male and female employees and provide them with adequate healthcare benefits and sort of like care facilities at their work facilities, etc. And this eventually has led to increased awareness about the importance of gender diversity within the company, and they report reduced harassment and improved retention rates. And this improved retention is really important for Damper because it helps them in retaining their talented workforce and in leveraging their prior knowledge to further improve the outcomes, financial outcomes for them over longer term. And at an investment fund level, there is a global venture capital company called Frontline, which does a lot of investments in B2B companies. And in 2015, what they've done is they've realized that their portfolio only has about 6 to 7% female entrepreneurs, and they really wanted to learn why their portfolio has only 6 to 7% female entrepreneurs. And a typical response from any venture capital fund for this would be that, well, there are very few female entrepreneurs, so we are able to fund only a few of them. So that's why the deal flow itself is narrow, and so we are able to only fund some of those female entrepreneurs. But Frontline decided that maybe there is more to this than narrow deal flow, and they've committed to understanding the gender biases that might remain in their deal flow and engagement process with entrepreneurs. And over time, they've tried to uncover and address many of their blind spots, which has eventually resulted in them investing about quarter of their portfolio into women-led enterprises in 2019 without having any quota or allocation for female entrepreneurs. It is done simply by uncovering gender-based biases within their deal flow processes. So in conclusion, in summary, what it essentially tells us is that if we really think deeply about how gender-based norms influence the activities that we are involved in, we will be able to identify potential risks and potential opportunities. And when we identify these potential risks and opportunities, we are in a better position to address them. If we do not identify any of these risks and opportunities, there is no way on earth that we can address those issues in future. So gender lens is adapting a gender lens in investment decision making is really about deepening our understanding of the portfolio companies and the environment in which they operate. Now, in times of COVID, there has been significant upheaval for women-led enterprises across the world, and gender lens investors have come forward to really help some of these women-led enterprises rebound from the crisis. So, for example, international financial institutions like DFC in DFC in the US, and Investing in Women Initiative from Australia, and private foundations like Visa have come together to issue large funding facilities to help women entrepreneurs weather the crisis. And fund managers also, like Small Enterprise Assistance Fund based in the US, and invests globally, has created emergency loan facilities, thereby helping women-led enterprises across the world really have access to greater capital, and which translates to peace of mind, and then use that flexibility to really understand how they can improve the safety and stability in employment for their employees and a broader range of stakeholders in their society. So some of the key takeaways that I think it would be important for us to discuss further about is that first, for any investor, one need not be classifying themselves as a gender lens investor. One need not be classifying themselves as an impact investor. For any investor who is interested in understanding their portfolio companies or their markets at a greater depth, they would benefit from adapting a gender lens. And especially for those who are seeking to create impact, adapting a gender lens and understanding how the social outcomes of a firm's activities influence men and women differently would really open new possibilities for them to deepen the social impact that they aspire to create. At the same time, if we were to hope for a resilient recovery from COVID, it is only possible if we have a inclusive approach towards tackling the challenges we have. And gender lens investors are already learning to take a deep commitment towards this inclusive approach of making investments. So we need to really promote this idea of adapting a gender lens in investment decision making and also in policy making and elsewhere to really aspire for a resilient recovery. And in conclusion, I really like the idea that Kai put forth earlier, that researchers and practitioners really need to come together and try to understand the best ways in which we can address some of the pressing issues in impact investing if we are to advance this industry as a whole. And here are some of the thoughts that I thought we could discuss further in that pursuit of deepening academic research in impact investing. Firstly, we need greater access to gender disaggregated data. When we look into impact assessment statements or reports put out by impact investors, not all of them collect data in a gender disaggregated manner. That really is a very simple starting point from where impact investors and researchers can try to understand how the social outcomes of investment are gender specific. And more importantly, we need to also understand if impact investing or gender lens investing more specifically has potential to influence deeply entrenched gender norms in the society. Is gender lens investing good enough only to, offer some sort of products in education, health, or financial inclusion? Or does gender lens investing over long term hold a greater potential to even challenge and influence social norms across the world about gender? And we also need to clearly take a deeper look into how adapting a gender lens could influence financial performance outcomes. As Kai mentioned earlier, there are hundreds, if not more, academic research studies which try to draw correlations between the presence of women on board and ESG performance or financial performance, etc. But such a broad stroke approach is to just say that a presence of women on boards is going to help with improved financial performance would be less helpful than if we were to take a much more deeper contextual view towards understanding the specific areas where gender diversity has a material role to play in improving financial performance. But here are just a few thoughts on how we can advance the practice and research in gender lens investing. And I look forward to continuing our conversation on what more we can do and what more we should explore. Thank you very much for your time here.
Thank you so much, Karthik. That was a great presentation. I will just ask you a couple of questions. Yes, congratulations. So you gave us this kind of global picture of the situation, the COVID situation now, trying to move beyond it. Are there any differences across regional or national contexts that you have picked up on that could help us also differentiate a bit between what is going on or what we can do?
Absolutely. So I live in Japan, but I'm originally from India. So let me pick these two countries as examples of what some COVID-induced differences are. Now, in Japan, what we've noticed over the last 5 to 6 years is a significant improvement in in women's workforce employment rates. In fact, women's workforce employment in Japan is now greater than some countries in Europe and greater than the United States. But an interesting caveat to that is that in Japan, much of women's workforce employment is through part-time positions. They do not go to work full-time because they also have responsibility of childcare and related elements. And companies did not companies in Japan were heavily influenced. They were not willing to offer the flexibility for women to sort of like work from home or engage in flexible work hours, etc. And that's why women were choosing to opt for part-time job roles instead of taking up full-time roles. But now, because of COVID, there has been a positive externality, which is that companies have more or less internalized remote work as a given. And this is now enabling women to across Japan to and even men to take up their childcare and household responsibilities while also being able to do a full-time job. And companies are also realizing that providing employees with flexible work is not so big a deal, and it is in fact very helpful in retaining talented employees over a long time without them leaving the workforce. So this is just sort of like a very slim silver lining in the broader chaos that COVID has induced. But in Japan's specific context, that's a positive silver lining. But now if we look at India, as I mentioned earlier in the presentation, there has been significant reversal, especially in areas of maternal health, reproductive health, girls' education and sexual education, etc. in the last couple of years, because much of this work generally tends to be in person and high touch. It's not internet based, and a lot of these activities were not being pursued in the last couple of years. And some people that I speak with worry that it would take many years, if not decades, for us to really fight back against the gender norms and expectations around women's role in household in India. So depending on the country, depending on the local context, what we can learn and what is happening because of COVID-induced disorder is very different. And there are both positives and negative outcomes resulting from this. And I think it would be interesting for anybody interested in adapting a gender lens to take a very country-specific contextual approach to how this unravels.
Thank you. Super interesting, these comparisons. Thank you. Then I just want to touch quickly upon your idea of there's a lot to explore, and I couldn't agree more. But what on going into the country and seeing the experiences of women, that's something that there's quite some research about. And you're right to say we lack data on the other side, right? The disaggregated data on firms' activity, outcomes, and so on. So you also have one foot definitely in academia. So do you have some tricks? Because what I see often is that firms are interested to get insights and I want to participate, but when we say, oh, can you share some data, suddenly it becomes much more difficult. So how do you convince them?
Right. I think that's indeed it's an evergreen challenge in that it's always difficult to access data, especially when investment managers believe or have a perception that the data is confidential and it has some secret sauce that they do not want to divulge with others. But what I've seen in the recent in the last few years, and I will pick two examples, offers a sign of hope that at a more structured level, it is indeed possible for academics and practitioners to work together. For example, Investing in Women initiative that has been seeded by Australian government has its strategy is to support a series of women-led enterprises in Southeast Asia by funding gender lens investment funds. And alongside building partnerships with investment funds, this initiative also has worked very closely with universities and created this consortium of academics and practitioners from the get-go, from the beginning, even before these funds are created. And that support of a sponsor like a grant maker or like a limited partner in telling that they are very interested in understanding the overall trends on how gender lens influences performance really sort of like motivates both researchers and also practitioners to collaborate and find ways in which they can they can really identify some of the issues pertaining the effects of diversity on performance, both financial and social. But if we do not have to rely on government bodies or grant makers even, and in some cases, private sector gender lens investing practitioners are also taking leadership. For example, Small Enterprise Assistance Fund, SEAF, which I also shared in the presentation, has developed a certain score called Gender Equality Scorecard, which they use to understand the gender-based performance effects of its portfolio companies. And they are now calling for partnerships with universities across the world to really transparently try and understand how adapting a gender lens is going to be material for the financial performance. So I think there are a few sort of like open-minded, transparent, learning-oriented private sector stakeholders who are even taking leadership in trying to build coalitions with academia. And there are certain larger funding agencies who can really bring together a much bigger group of gender lens investors to come together and do research. So those are signs of hope. But I think in a more broad sense, I believe if academic researchers and practitioners work together about and build consensus on the need to answer these research questions well before the fund has been created. And if there is some sort of like a organic exchange between both stakeholders on what can academic research inform the fund managers in terms of improving their strategies, and how can fund managers then help academic researchers in further uncovering more issues by rigorous work, could that sort of like organic synergy well before the fund has been created, I think could be an interesting place to explore, but that's an open question still.
Wonderful, Karthik. That was very, very inspiring. And I'm sure people in the audience have many questions. Please keep your questions for the part after Laura's speech, where we'll also open the floor. You are welcome to already put some of your questions in the chat, and we won't probably have time to go to all of them, but you can already start this. So thank you so much, Karthik, and we can unshare your screen, and I will invite now Laura Kemp-Pedersen to share her screen and share her wonderful insights. We have talked a little bit to prepare this session, and yeah, you're up for yet another ride. We can see Laura.
Can you see the screen, Florence? Yeah. Okay. Super. Thanks. One sec. Let me get it back myself. Okay, great. So, Karthik, thank you so much. That was such good ground setting for what I want to talk about. And Karthik has really talked about, the gender lens investing at the portfolio level, and then through to women entrepreneurs. And I guess what I really want to do is I want to take that up a level and explore a little bit the fund manager level and what's going on there, and how that has a downstream impact on scaling GLI. So the most important thing to say here, I think, is what I've underlined here: who gets funded impacts which problems get tackled and which don't. And we know that COVID has had a significant impact on where we were with meeting the Sustainable Development Goals. And not only is gender equality a precondition to its own SDG, but to the other 16 SDGs. And we have really, in private equity and venture capital and the impact, and therefore the impact space, a really serious and systemic problem with getting women fund managers backed. And if we are not getting those fund managers backed, and I'm going to come on in a minute to talk about how many of these fund managers are actually first-time fund managers, these women, which is an even bigger challenge. We are not going to, if we don't get more of these women backed, we are going to have a very difficult problem with meeting the Sustainable Development Goals. And so over the last year, I've been doing quite a bit of work alongside of investors about looking at the problems they have currently with investing in first-time fund managers. So here's what the data says. And you know, any data you look at, you will never find more than about 2% of total capital raised going to women managing funds in the private equity and venture capital space. And so you can see here, in 200 years, that's the estimate of time it will take for women, you know, to reach the same representation in asset management as men. And we know with the challenges that we face, we don't have that kind of time. The issue is also exacerbated by, you know, the number of women who are in private equity overall. So, you know, we generally see 10 to 12% total women in private equity, of which the numbers vary between about 8 and 10% of those being in senior roles, meaning they're, you know, on IC and allocating capital. And just to give you, you know, just to give you an indication, in 2020 was a record year for fundraising in private equity. There's 282 billion raised, notwithstanding COVID, which is incredible. At the same time, the private equity industry was sitting on $1.7 trillion in dry powder, so a capital that's undeployed. And at the same time, if you go back to the stat I gave you earlier, you've got only about 2% of total capital going to women. So the capital is certainly there, and there's an issue with deployment. Just to go back to, you know, connect this to what Karthik talked about, you know, why is getting more capital to these women important? It's important for a number of reasons. Number one, we know, and the data shows that women who are allocating capital are more likely to allocate that capital to women. So in order to increase the, you know, amount of capital going to entrepreneurs anywhere, you know, emerging markets, Denmark, US, we need to increase the amount of capital that women fund managers are managing. And, you know, one of the things that, you know, we've been looking at the past year and aggregating is, you know, what does the data say? And actually, there's quite a lot of data out there that has not been pulled together into one place previously, that actually shows us that investing in women fund managers makes commercial sense. So here you can see here is 69% of the top performing funds had female GPs, and there's actually quite a lot of PitchBook and Preqin data that shows both that women and first-time funds actually can generate higher returns than, you know, funds, GPs on Fund 2 and Fund 3, et cetera. And then also, you know, there's an important case to be made. If you look at, you know, we talk about getting more women backed as impact in itself, but also if you look at where women starting funds are investing, and particularly, women running funds are investing, and particularly first-time funds, they are investing with an impact lens. So backing more women means we will be able to scale more capital for impact investing. So about a year ago, we set up a group through the Gender Smart Investing Summit, which was sponsored by Visa Foundation. And we really wanted to look at this problem of getting women backed and, what it would take to, what it would take to move the needle. So we put together a group of about 50 investors and other ecosystem players, the DFIs, the big banks, a lot of the, US big foundations, Rockefeller, Ford. And we really spent the last year speaking to both fund managers and investors to understand what the issues were for each. And then the output of all of this is we've developed a guide for investors on how to think about investing in these women. So from that qualitative research we did, here just run through for you a couple of the key issues that are faced by women. So, we hear time and again, women are facing an exclusionary situation, so they don't have the same networks that men do. And therefore, that has an effect on how quickly they are able to raise capital and achieve closes for their funds, if they're able to achieve it at all. And, unfortunately, I know an awful lot of women who have given up, and particularly in the last year when COVID has been very difficult. What they're experiencing is that investors are applying the same criteria to both established GPs as well as other funds where they may have been set up by people who have spun out of a private equity business. But if you think about the fact that there is only 10%, only 10% of 10 to 12% of private equity venture capital are women. The women that are coming in to set up funds, they do not have those traditional track records in many cases. So they might have sector expertise. They might have done a type of investment, but they haven't spun out of a private equity GP. And investors have a very limited view they want to take on how they, diligence and evaluate risk when it comes to fund managers. Size and assets under management are a big issue because, you can see here on the right, the typical fund size is between 20 and 100 million. It's really hard for a lot of investors to do smaller investment size. They don't want to come in at half a fund. Women also talk about facing the issue of, spending considerable amount of time, and these are very under-resourced individuals in the first place. In many cases, filling out numerous due diligence requests, they never hear back, or they meet with an investor and the investor, asks them then to change the fund size before they invest, and they change the fund size, and then they come back and they ask them to change something different on their, thesis or the number of verticals they invest in. So the goalposts are moving all the time, which is really frustrating. And another thing is that a lot more investors are coming to the table now with concessionary capital, or they want to put these fund managers into an impact bucket. And actually, they don't want that because they want to be considered purely commercial. So that's an issue for a lot of fund managers. And really, perhaps the biggest issue is the unconscious and systemic bias that exists when you have an industry where 90% of allocators are one gender, and that's a huge ongoing problem for the industry. In terms of the fund managers who I've spoken to over the last year, I mean, COVID has had a really big impact on them, as is the case across the board, and not just in this space. Investors are doubling down on the investments that they already have, and that is where any additional capital is going to. They are so the effect for that for first-time fund managers has really been, instead of in many cases trying to trying to achieve fund closes. They're trying to pull together money to to invest on a deal by deal basis in order to get going on some kind of track record, which has been hard. And then you can see here that, private equity did a study and they said, a third of investors in this COVID period have just said, we're not going to fund first time fund managers. We're going to reduce our risk. For the investors that we spoke to, first time fund managers in combination with gender lens investing, which many don't understand still, or they think is just investing in women's products, is considered really risky. And then when you add in, fund managers who are doing this in emerging markets, their risk factor goes even higher. A lot of investors, some of the bigger foundations in the US, they want to be catalytic. And they don't see how, investing in a few women starting funds is going to have an impact on the overall field. Size is an issue, which we talked about. It's a big resource issue. A lot of investors say, to work on smaller allocations. Track record, again, not being willing to expand how they evaluate these funds, which is really, I think, one of the biggest issues in this space, and is really limiting how women can participate. Also, what we've seen during COVID is that whereas a lot of investors were starting to really focus on gender, they have actually pivoted towards racial equity, particularly in the US, and made that a priority in how they want to focus their capital. And then, what persists, and Karthik touched on this a little bit, is there's still a lack of understanding amongst a lot of investors about the commercial as well as impact upside of investing in GLI. And so what we did is we developed a guide, which we launched a few weeks ago at an event where we had almost 200 people attend, and more than 50% of those were investors. We simply developed a guide to say, here's the data that shows you that investing in these first-time fund managers is viable and can generate both impact and returns. We've interviewed a lot of incredible investors who are already doing this. So the Pivotal, which is Melinda Gates, a private equity firm, and the Deputy State Treasurer of the state of Illinois, who are allocating to first-time funds. We've included in there investment policy language. So, as with impact, if your investment policy language is enabling of these types of investments, then that is a positive place to start. There are examples in there about from other funds about how to diligence first-time fund managers, and then resources on where to find pipeline, because I can't tell you how many times I have heard from investors there is no pipeline, and there certainly is. It's just a case of really opening up your networks and knowing where to look. And so that's what I wanted to share with you today. I just leave you with a few quotes from the guide, and particularly for me, I love what Rodrigo Garcia here says. Super interesting individual. He was an immigrant. His family were illegal immigrants from Mexico, and it's so wonderful to see somebody like him, responsible now for 40 billion in capital, really thoughtfully, as an institutional investor, who are the types of investors, the pension funds, they just say they cannot invest in first-time fund managers. So he's proving it's not true. I think if a pension fund like the state of Illinois can, open their minds and look at backing more women, backing diverse founders, and backing first-time fund managers, anybody can do it.
Thank you so much, Lara. That was so interesting, and I think you can, I mean, you can also show your video, and and if you can share the quotes at some point in the future with the participants, they are very inspirational.
Well, I will drop the link to the report in here.
Excellent.
In the chat, if that's helpful.
Yeah. So Laura, just a couple of quick questions before we then open also to the floor. So you very well showed this kind of, what happens with gender in investment, and then also the impact of COVID, and you have this guide. But what is your impression as a professional in impact investing? Is diversity higher or lower now in the agenda with the COVID crisis? And what are the reactions to your guide?
Yeah, I mean, I think there's a lot of, there's really been an elevated discussion around gender as brought on by the COVID crisis. And particularly, I mean, we've never seen so much discussion before about the care economy, which is largely women and then also women of color. And I've never seen so many valuations for what the care economy's contribution is, to the economy overall. So I think that there's a lot more focus on gender, and then there's a lot more focus on diversity, particularly. I do a lot of work with investors in the U.S., and of course, when you look at everything that's happened there over the past year on from an racial equity standpoint. So I think that that is very good, and I think there's been when we talk about building back after this crisis that we're still in, there's a clear linkage to me to how we cannot achieve sustainability unless we achieve gender equality. And I don't think that there's been, we're anywhere close to solving it, but I see that as a deeper realization than ever before. So that's the first part of your question. The second part of your question is, I guess it's the first thing to say, 200 people showed up, for the launch of the guide, which we were delighted with, and it has had a lot of very positive feedback. There has not been a lot of sort of aggregation, as I mentioned earlier, of the data that makes the case. And there is we didn't include it all, but there is quite a lot of data that shows you that investing in women equals impact, but it in fact also equals returns, and in some places higher returns than we're seeing with more advanced funds. So we did it for two reasons. We did it just to raise awareness of this being an ongoing issue globally. We did it to say, here's what the opportunity is, and really to bring forward some of those amazing investors who have already done it, to show others that it can be done. And so the feedback has been really wonderful.
Excellent. And I haven't read the whole guide yet, but I certainly will. It's also going to be helpful for my teaching. Thank you so much.
Great.
And actually, the next question is actually my question, but I can also see the question from Anirudh in the chat that is a bit in the same line. So I was about to ask you how we can actually nudge more women also to enter the funding side of the story, so to become investors and impact investors. And I guess Annie Hood is right in saying that, well, this also probably means that we need to nudge more women into studying finance. So do you have some thoughts about that?
Yeah, I mean, I think that we have to do things differently, and we have to make it easier for women to come into doing things like, setting up their funds, even if they haven't worked at a private equity business for 10 years. And right now, there's some that is starting, but the way the system works today, it doesn't work for women. It just doesn't. And I think that we have to acknowledge that. And then we have to say, okay, let's tear up the traditional idea of, what it would be like to woman goes into private equity firm, works there for 10 years amongst, 90% men, hopes to get promoted to partner, and then spins out and sets up her own fund. It doesn't work. It's not working. What you're seeing now, I think, which is really fantastic, is you're seeing some different approaches to, okay, how do we do this? So for example, Visa Foundation. Visa Foundation has a new head of investments, an amazing woman, Nayada Kambali, who's come from Calvert Impact Capital, where she basically established the GLI investing over the last 10 years. And what they're doing is they're putting together their grant capital with their program related capital. And, they're specifically going to be investing in first-time women funds, but with concessionary capital and commercial capital. And what that will allow women to do is it will allow women enough money, to warehouse some deals, build a track record. So they're doing it that way. The 2X DFI Collaborative also is they've just announced a $15 billion commitment to GLI. First they said they would do 3, and then they actually pulled together 7, and now they said we're going to do 15. And one of the things that I've been working on with them and they're going to be doing is they're going to be putting an accelerator together for first-time funds. So again, bringing women in, giving them the support on the the regulatory side and the structuring side, and hoping to bring in some capital then to get them going. So these are facilities that are specifically being developed with women in mind, and that's what I mean when I think that when I say that the system has got to change. It's just we're never going to get to where we need to get to if we just keep doing the same thing.
Thank you. And with role models like you, I hope that we can also change some of the patterns at CBS, because I know from some research with students that it's definitely a decision-making point for the women. Say the finance programs, they know it's going to be hard, also because there are women in that group. So we are of course working on helping that they don't sort out to over studying queues and job queues. Thank you so much. I will go now and open to the different questions from the chat. So please, you can add questions. There was a question for you, Karthik, from Andrea Mestro. He's asking, can you describe a couple of bankable projects as a result of GLI?
Thank you for the question. Fundamentally, I think the way I perceive GLI is that gender lens investing is not new. It's sort of like not an independent investing activity. Any investment that is done could be impact investing or could be not. Any investment that is done would benefit if we take a gender lens to that investment and try to understand that investment at greater detail. For example, like when we think I shared the example of this venture capital fund called Frontline. What they've done is they do not deliberately try to call themselves a gender lens investment fund, and they do not deliberately try to allocate a certain quota for investing in women. All they do is to understand their entire investment process with a gender lens and see how they can improve their deal flow. For example, if they've previously been able to identify only 5% female entrepreneurs in their entire deal flow, now they're able to identify much larger amount of female entrepreneurs. It's not that their deal flow remained the same and the number of female entrepreneurs in it increased. The deal flow as a whole has grown by understanding the biases that their processes have. They're able to access more entrepreneurs than their competitors. Now, will that help that venture capital company generate better returns? Theoretically, yes, because they're able to tap into a much wider pool of investment opportunities at an earlier stage than their competitors. But in terms of practice, we will have to wait a few more years to see how their returns have played out, because they've started doing this only a few years ago. And the same applies to a significant majority of private market gender lens investment funds, in that majority of the funds have been created just in the past 5 to 6 years, and none of them have sort of like a full fund exit yet, or very few of them have a full fund level exit yet, for us to clearly sort of make a definitive evidence-based case to say that gender lens investing has indeed outperformed by X% in private markets. But at a conceptual level, I believe that if we deepen our analysis on what we can understand of our portfolio companies, we will indeed be better off. So it's not as independent, unique investment style, according to me, but rather it is a sort of like an important component of any investment activity across the world, if one wishes to really take this seriously.
Thank you. That was a great answer. Yeah, now it's back. I think it's more a question for Laura. It's about the care economy that you mentioned, and Fiona is asking, in that kind of parts of the economy. And I would add, for example, on Monday I have some students defending a master thesis where they talk about femtech, which is also where there are a lot of women doing something for other women. So how in these cases do you propose bridging the gap between traditional investing criteria and impact investing? Because I guess from the other side, it's not always, very clear also for the ones who are looking for fund, like where should I look? Is there a clear case that if you want to start something in care or in femtech, you can go for impact investing, or is it more about bridging the two types of investment?
Sorry, I'm just reading the question. How do you propose bridging the gap between traditional investing criteria? Is this in terms of taking capital, or Florence?
That's how I understand it.
Yeah. I think it really depends on, to me, it's all about intentionalism. For me, an impact, if you want to take capital for impact, and you want to target impact investors, you really need to have intentionality. You really need to be clear about what is beyond the commercial returns. What is your theory of change? What metrics are you going to put in place to ensure that you have the returns? I mean, to me, it's still a gray line. But if but there's a lot of focus going into now how we look at impact, how it's measured, and I think that I prefer to, if you're going to call yourself impact, my preference is to see that you have those things, you have your theory of change, and you understand where your impact is going to be, and you measure it. But it's still very gray. It's still very gray. What is impact, and who allocates impact dollars and what they allocate it to. So I think it's still a developing space.
Thank you. Karthik, do you have any thoughts? on that about the kind of gray line, as Laura calls it, between impact investing and traditional investing, and how the gender lens might fit into this?
I think it's an interesting question, because generally, for example, whenever it reminds me of a few conversations I've had with people working in finance, and whenever I introduce them to the idea of impact investing, saying that impact investing is about investments that create social impact, then they immediately jump on me and say, all investments create social impact. What are you talking about? So it really also is a matter of what exactly we mean by the definition of impact is rather unclear, and it means different things to different people, and that is where the confusion lies. For example, starting a large supermarket and employing 100,000 people in a supermarket is creating great amount of employment value to people in a certain community. But a typical impact investment fund would not probably call that as an impact investment in a more narrow sense. So because social impact is such a fluid concept, and what we mean, the issues that we personally relate to, or the issues that are pertinent in a certain context, vary significantly between different groups. And so since our definition of impact varies, what we can or cannot call as impact investing also clearly changes. So I really don't see much value in trying to draw a certain red line saying this is impact investing and this is not. But in general, I think it's a useful idea to, just as how we apply, how it's good to apply a gender lens and think about gender-based consequences of any investing, it would also be useful to apply an impact lens and see how is our investment influencing, impacting, different social and environmental outcomes, and then face a honest question of, do we care? I guess at the end of the day, maybe impact investors are more confident in saying we care and we are going to report about this and we are going to try our best to to create more positive externalities than negative externalities. So that's my broad view.
Yeah. I think the other thing is, it's also a question of where you're trying to get your capital from, and how you're going to get that capital and how you position yourself for that capital. And to be quite frank, you may be the same individual, and one day you may be positioning yourself as impact for capital for one investor, and the next day trying to get capital from somebody else, and not positioning yourself as impact. So it's really, it's not I don't know if gray is the right way to describe it, but it's you can't put parameters around it currently.
Great. Thank you. I'm going to paraphrase the German philosopher Wittgenstein and say, you recognize impact when you see it. That's the conclusion. We'll take a very last question, and there are many questions popping in, and I'm sure you can look at them. But I'll take the one from Edwin to finish from Ghana, who points out also to this kind of tendency that the investors are in the global north, but a lot of the opportunities for investment are in the global south. So how can we, kind of change the story a little bit there and mix this up a little bit more efficiently and more equally?
I love the question because, I've spent a lot of time in Ghana, which is a very special place in particular. And to be honest with you, I mean, the innovation that's happening there and the entrepreneurialism, I think, is incredible. What is interesting, and I'm working with one of the big African private equity GP right now, and what we're starting to see is a really incredible shift. First of all, Africa investing in Africa versus the investment purely coming from outside in. And also the other incredible thing that trend that we're seeing is it used to be sort of innovation coming out in, and now not only is the innovation coming from Africa, but it's being exported around the world. I'm talking about AI and mobile and all kinds of really cutting edge technology that is really transforming things from an impact standpoint on the continent. But then, maybe, there was something recently, it was generated in Nigeria, but now actually they're taking it to Brazil, same population, similar problems. So I think the next 10 years are going to be super exciting. What do you think, Karthik?
Yeah, I think the question from Edwin is indeed a very important topic that often does not, gain as much importance as it should, perhaps. But I would hypothesize that, and I could be wrong about this, but I would hypothesize that one of the main reasons why there may be a lot of investment funds based in developed economies is because much of limited partners and much of funding agencies that invest in these funds are in developed economies. And as Laura mentioned, when we think about gender lens investing, female fund managers find it very difficult to break into typically male networks and really able to access capital from this group of institutional investors and asset owners, etc. And the same sort of like closed network, old boys network, could influence or hinder the extent to which fund managers based in emerging economies may have when they try to raise capital and when they try to reach out to global institutional investors, they would perhaps be at a slight disadvantage if they do not come from the same sort of like a closed business school network or a closed old boys network or whatever we might call it. So I think in reality, it might simply be the case that much of capital indeed still is perhaps in developed parts of the world, and there are not enough and I guess people attracts and in general that has some amount of implications in terms of emerging market fund managers being able to attract capital. But I think there is a great deal of positive signals that we can see, and Laura mentioned a few examples of reverse innovation, and that's a topic that I very closely follow and I'm fascinated about. But at the same time, we are seeing very strong and large fund managers emerging from developing countries and being able to attract capital from global investors. I will give you one example. There is an Indian fund manager called Avishkar, and Avishkar has been able to raise more than $1 billion across multiple of their holding companies to pursue impact investing in India. So over time, as evidence is created, as these fund managers create strong impact and evidence base, I think the inherent biases that fund allocators, LPs, would be shattered over time with good evidence, and that's the longer term route. But I do not want to wait many decades to see this longer term route manifest into reality. So I'm excited to hear if there are any more accelerated solutions we can pursue in this manner.
Thank you so much, both of you, Karthik and Laura. I think we could talk for at least one more hour. And I would love that, but then Kai is not going to love me anymore. So thank you very much, and I'll give it over to Kai now.
Great. You did really great. And actually, well, thank you very much, Florence. This was an excellent opening for the conference. Thank you, Laura and Karthik, for really going into the detail on this topic. What is going to happen now is that the next sessions, there's 2 sessions that will start at 11. I will in a minute post into our chat the links, just in case you don't have the links for that. You have 10 minutes if you need to grab a coffee or take a break. However, what I wanted to offer you is also the possibility to break us into smaller groups. I'm going to do this now. You're going to get automatically put into those groups. And the idea there is that you just kind of like do what you would normally do at the end of a workshop like this. You get up, you talk to the person sitting to the left, to the right of you, or the person you bump in at the coffee table. So if you'd like to do that, just hang around for the next 6, 7, 8 minutes. You're going to be in groups. They're not moderated, so you'll have to speak up, introduce yourselves. It's completely random. And then please, by 11 o'clock, come and join the 2 breakout session rooms that we're going to set up there. Once again, thank you very much to our excellent team here. I'm going to post the link now to the future sessions so that if you can go there. And now I'm going to push the breakout the breakout rooms, and let me see this. Create. Here you go. Just go ahead. Once you're in the rooms, introduce each other and talk a little bit about what your interest in this topic are, your experiences are, exchange contact details. And you, by the way, you can also access people via LinkedIn. So during this event, you can send messages to people on LinkedIn, even if you're not in contact with them. So that's another possibility. And with that, I'll send you off into the breakout rooms, take 5-6 minutes, and then at 11 o'clock, you'll continue in the next session. Okay, bye everybody. Once again, thank you very much to an excellent panel that you have done, Florence, Laura, and Karthik.